5 business credit scores lenders use to judge. You are obviously familiar with your personal credit profile and score. You have credit with 3 consumer reporting agencies, TransUnion, Experian, and Equifax, that provide profiles and scores for you individually. A consumer credit score is a mathematical model that is used to depict a consumer's risk of going 90 days late on an account within the next 24 months. The most popular score is the FICO score, ranging from 350. Here's a look at the breakdown of the most popular consumer credit scores, the FICO. Your business also has its own credit profile and score linked to your business EIN number. 3 business reporting agencies provide your business credit profile and score: D&B Bradstreet, Experian Commercial, and Equifax Commercial. A business credit score is a mathematical model that is used to depict a business's risk of going 90. A business credit score reflects the business's likelihood of defaulting on an obligation, not the business owner's. The business credit score is based on how the business obligations are being paid, not how the business owner pays their. Each reporting agency provides access to approximately 5 business credit scores that evaluate different forms of risk. FICO also provides its own business credit score to assess business risk. And banks have their own internal bank credit score that's used to determine business. Of all the scores that are available today, there are 5 you should become very familiar with. These are the 5 core scores that lenders and credit issuers use most to determine your. Yes, your business credit scores are used each and every time you apply for credit and financing for your business. But lenders and credit issuers will not tell you this, nor tell you which scores they're using to assess your business. There is no Fair Credit Reporting Act in the business world that requires them to do so, as their. It's also important to note that your business credit profile and scores are available to anyone who wants them. In the consumer world, someone needs your permission to pull your consumer reports, something the FCRA calls permissible purpose. But there is no FCRA in the business world, so anyone who wants your reports can easily and cheaply get them, including competitors, prospects, clients. Score number 1. Dun & Bradstreet's Paydex score. The main credit score used in the business world is known as a Paydex score, provided by Dun & Bradstreet. From D&B. The D&B Paydex score is D&B's unique dollar-weighted numerical indicator of how a firm paid its bills over the past year, based on trade experiences reported to D&B by various vendors. Dollar-weighted means that D&B gives more weight to accounts with higher limits than ones with lower ones. How a firm paid its bills over the past year means this score is based on past performance as the main driver. The Paydex score ranges from 0 to 100, with 100 being the best score a business can obtain. A score of 80 or higher is considered good or healthy credit. A business can obtain a good business Paydex score by ensuring payments are made properly. Business credit scores are based only on whether the business pays its bills on time. As you can see here, your Paydex score literally reflects how you pay your bills. If you pay on time, you have an 80 score. But if you were to pay 30 days late on average, your score. A business will need a Paydex score of 80 to obtain the most favorable financing. To obtain a Paydex score, a business will need at least 5 trade accounts reporting to their file. It can take as long as 90 days for those trades to report and a score to be established. The business credit score itself is calculated by using as many as. Now let's talk about the D&B Predictive Scores. Predictive scores predict a company's expected performance over the next year or 12-month time period. D&B provides 3 predictive scores: D&B Delinquency Predictor Score, Financial Stress Score, Supplier Evaluation. The three D&B predictive scores are: the D&B Delinquency Predictor Score predicts whether a business will pay its bills on time. The Financial Stress Score predicts the chance that a business will experience financial distress. The Supplier Evaluation Risk Rating predicts whether a business will stop delivering its goods and services. D&B's performance scores reflect a company's past performance using only information within the D&B database. D&B provides two core performance. The two D&B performance scores are: the D&B rating indicates a company's net worth range based on company financial statements as well as a company's overall condition. And the Paydex score indicates how a company has paid its bills over the last 24 months. Score number 2, Experian's Intelliscore. Experian's most recent score system is known as Intelliscore Plus, which they boast of as the next level in credit scoring. Intelliscore Plus takes into account hundreds of variables to offer a business score between 0 and 100, with 100 being the highest. Intelliscore actually predicts a business's risk of going seriously delinquent or over 91 days late or having a major financial issue. The 0 to 100 is a percentile score that reflects the percentage of businesses that score higher or lower than the specific business being looked at. For example, if the business has a score of 20, this means that company scores better than 19% of other businesses. That also means that 80% of other businesses score higher than that business. The new Intelliscore Plus has over 800 aggregates or factors that affect the credit scores. Experian first takes a business and looks at data segments such as firmographics, public records, collections, and trade information. Then the first model is their commercial model for small, medium, and larger businesses. Second is their blended owner model, where the commercial data is then linked with the owner's information. Thirdly, there is the Intelliscore. Intelliscore Plus, just like FICO, has multiple facets to the entire score makeup. The score is still based on the payment history of the business, but many other factors tie into percentages of the overall score. The historical behavior or payment history accounts for 5 to 10% of the total score. Current payment status, trade balances, and percent of accounts delinquent account for 50 to 60%. The business's credit utilization affects 10 to 15% of the score. This has to do with the amount of credit that has been extended to the business in relation to the balances they currently have on those accounts. The company profile, age of business, industry risk, and size of business assessed by number of employees accounts for 5 to 10% of the total score. And 10 to 15% of the total score is determined based on the derogatory items, collections, liens, judgment. Here's a better look at how Experian. With Intelliscore, scores are based on a number of factors contained in your business credit report: number of trade experiences, outstanding balances, payment habits, credit utilization, trends over time, public record recency, frequency, and dollar amount, demographics such as years on file, standard industrial classification codes, and Experian's Financial Stability Risk Score predicts potential of a business going bankrupt or defaulting on its obligations. Scores range from 1 to 100, broken down into 5 risks. Experian's blended score is a one-page report providing summary information on both the business and the business owner. Research shows that a combined business owner credit scoring model is more predictable than business or consumer-only scoring model. Score number 3, Equifax's Credit Risk Score. Equifax's main business credit scoring model is the Credit Risk Score. This score was created to predict the probability of a business customer becoming seriously delinquent 90 days late within a 12-month period. Credit scores range from 1 to 100, with a lower score indicating a higher. Equifax's credit risk scores of 90 and above express that obligations are being paid as agreed. Scores from 80 to 89 indicate payments are being made 1 to 30 days overdue. Scores of 60 to 79 represent payments being paid 31 to 60 days past the agreed-upon due date. Credit scores between 40 and 59 indicate payments being made 61 to 90 days overdue. Scores between 20 and 39 mean obligations are being paid 91 to 120 days overdue. Scores between 1 and 19 mean obligations are being paid 120 plus days past the due date. Here's a better look at how Equifax's credit risk score Equifax Commercial offers other credit scores as well. Credit risk score predicts the likelihood of a business incurring a 90-day severe delinquency or charge-off over the next 12 months. Business failure score predicts the likelihood of a business failure through either formal or informal bankruptcy over the next 12 months. Payment index provides a dollar-weighted index of a business's current and past payment performance based on all payment experiences in the. Score number 4. FICO SBSS score. The FICO SBSS score is a measure of your small business's creditworthiness. This score is becoming very popular with lenders. This score has also become widely used by SBA to qualify business loans. It's based on both your personal and your business credit history, not just your business as the main business. The SBSS was actually launched all the way back in 1993. Since SBA started using it to evaluate all 7A loans under $350,000 in 2014, it's now become even more popular. Scores reflect FICO SBSS scores range from 0 to 300. Higher scores mean lower risk, so the higher score you have, the better. Personal and business credit history as well as financial data are used. As of 2014, all SBA 7A loans must go through a business credit score pre-screen. For SBA loans, you won't be approved with a score below 140, but they typically set the cutoff as high as 160. Below that, you'll probably be denied because of being too high a risk. Actually, chances are good that SBA lenders won't even submit your application to SBA if your score. Many factors are taken into account to calculate the FICO SBSS score. Some include the owner or co-owner's personal credit information, business credit history, age of the business, years in business. Other factors calculated into the score include cash flow, revenue, the last 12 months of Paydex scores from D&B, liens, judgments, any other known financial. If you have no business credit history and limited time in business, the highest possible FICO SBSS score you can get is 140. But even to get that high of a score, you'd have to have pristine personal. SBSS models are validated for term loans, lines of credit, and commercial cards all the way up to $1 million. This helps credit issuers making evaluations for larger transactions. If you are applying for bank financing of $1 million or below, chances are good that your SBSS score is being evaluated. SBSS gives small business credit issuers different combinations of data to evaluate the risk of a business. For example, a credit issuer can choose to only evaluate the application data of the principal owner, or they can choose to also include data from one or more of the business bureaus, or they can choose to wait. This is a highly intelligent score because it automatically goes from one business bureau to another in whatever order or priority the credit issuer chooses to generate a score. So if a lender prefers the Paydex score as a default, the SBSS pulls that data set. If there isn't enough info to generate a score, it then automatically checks another business score, such as the Experian Intelliscore, or it can even move on to the Equifax. Score number 4. Bank rating. Bank credit, or bank rating, is the total amount of borrowing capacity a business can obtain from the banking system. This is not the same as business credit, which is a much broader category of lenders such as suppliers, credit card issuers. A business can secure more business credit quickly as long as it has a minimum of one bank reference and an average daily account balance of at least $10,000 for the past 3 months. This yields a bank rating of low 5, meaning an ADB of $5,000 to $30,000. A lower rating, say a high 4, or a balance of $7,000 to $9,999 won't put a stop to the business's application, but it will. Here's a look at how your bank rating breaks down. Business owners should do whatever they can to keep at least $10,000 in their account over a 90-day period. The money should be kept there just to ensure the bank rating is high enough to increase future financing approvals. Each cycle is based on the balance rating during the previous 3-month period. So before a business decides to apply for credit, it should keep a balance rating of. Other bank rating factors include number of non-sufficient funds charges on your statements, positive cash flow, consistent deposits, the age of the account, the bank products the business uses, and any savings account. In summary, paying business bills as agreed will net a positive credit score with D&B, Equifax, and Experian. Your personal credit can be blended into the FICO SBSS and Experian Intelliscore Plus. Having a good bank rating is mostly about keeping an average of $10,000 in your bank account over the last 90 days.